Hello, happy Thanksgiving, and welcome to the Market Carver. I'm Adam Harder, Chief Investment Officer. So thankful you chose to spend a few minutes with us as we carve up the markets. Maybe while you're carving up the turkey, we can give you some of the economics to go along with it. So yeah, we're going to cover one economic point, and then we're really going to illustrate and paint a picture of what type of market we're in vis-a-vis the S&P 500, and underneath the hood, which types of stocks are doing well. So first, the economic stuff. We've really reached an interesting point with regard to the savings rate. So the savings rate's a simple concept. It's how much income minus the spending across the aggregate economy. So the savings rate spiked last year as we shoveled a lot of money into individuals' pockets. And of course, there was nowhere to go with that money. So savings really shot up, and it's worked its way back down to where we are back to pre-pandemic levels. So that's interesting for a couple of different reasons. Number one, it really paints just how solid demand has been here as of recent, drawing that savings rate down, coupled with really strong wages. Those two things have spoken to strong underlying demand in the economy. The second is going to be how we move forward and how this interacts with the labor market. There's a reasonable assumption that as savings rates were high, that was cushioning and holding back, at least to some degree, the progress in the labor market. So this isn't going to be something that pivots and changes the job market on a beat. But on the margins, it should encourage a little bit more of those massive amounts of job openings to continue to be filled. At least that would be our base expectation, that we continue to recover and heal those permanent jobs in the U.S. economy. Looking now to the S&P 500. So got a lot of squiggly lines here. But first of all, the top panel is the S&P 500. And you can see it is in a positive trend. We say that because it's above that green line. But underneath there are three different lines that are important for us to understand the dynamics of this market. They are simply measuring the percentage of those 500 stocks that are above their various moving averages. And that gives us an indication for how many stocks have good, solid, positive trends. And Andrew Thrasher is our chartered market technician putting this together. And you can see the red arrows pointing to the down. That means we have some down trends and a couple of different of those indicators. And those are the percentage of stocks that are above both their 20-day moving average and their 200-day moving average. In both cases, they are declining. So that's telling us that fewer stocks are participating in that broader S&P 500. This is a movie we've seen play out a couple of times over the past several years as those few stocks have driven the S&P 500 to new highs, and we've stalled out underneath the hood and seen a lack of participation, and we're starting to see that once again. That's one thing that we're wrestling with. We're at the part of the calendar that is typically favorable for smaller companies. They're taking a little bit longer to kick in. There's still the possibility that December, January, strong small cap months, that would turn around. But for now, it's not quite turning around with that seasonality. So something that has RI, and this would go hand in hand with that, and that is the S&P 500 clearly being back in the hands of the FAAMG stocks. So these are the big kahunas: Facebook, Apple, Amazon, Microsoft, Google. Those stocks are very clearly leading the charge. Again, you have the S&P 500 in the top panel. But the bottom is measuring a couple of different things versus that S&P 500. The first is those FAAMG stocks, each one of those getting an individual vote in a basket that is relative to the S&P 500. S&P 500 is the divisor. So as those stocks are outperforming and getting bigger, you'll see that going to the uptrend. So we went through a period where small caps and we were broadening out and we were recovering. You can see that's the red arrow in the middle of that middle chart. That was where we began to see the broader market again do well versus those stocks in control, but we have passed the baton very clearly back in the hands of those mega caps. Conversely, you can see an equal weighted S&P 500. So we take those 500 stocks and how are they doing relative to the S&P 500, and they're at a point where they are beginning to underperform. So both of those two slides are telling us the same thing, that we are concentrating this market into the hands of a few key players, something that we've seen play out a few times. It's a much healthier. We'd much rather see a broader market that's greater for diversified portfolios that can't necessarily overly concentrate on those few stocks. One last way of showing that. So it's not just in this case a value versus growth dynamic, because this is a measurement of growth stocks, and so it's even further away from that growth dynamic, and it's just a few of those growth stocks. You see the Nasdaq 100 is recently at a new time high. The past couple days here, we've seen it come down a percent or two, so a minor little pullback. But right before that, the Nasdaq 100 was at a brand new all-time high, and those are 100 stocks. We can see on the list here on the screen a list of those 100 stocks and how far they are down relative to the high. You see a lot of names that range from a 37% to an 85% drawdown. So there is a tremendous amount of damage. It begs the question, at what point in time do we see these go into the bargain bin? Some of these, of course, are names that once upon a time were high flyers that won't make it to revolutionizing the economy going forward. Some will. So our job is to separate those and to find a few of these. There's undoubtedly a few of these names that have reached a place to pick them back up and put them in the portfolio. But the broader point, again, is that we have a handful of stocks really driving this market, and there's a lot of damage to portfolios that have diversification and a lot of companies exposed in the portfolio. So that's something we have our eye on. Again, we're moving to the positive part of the seasonality, and that's a good opportunity for things to turn around, but it's not quite getting to the punch. We definitely want to see that synchronize or line back up, or that'll be another yellow flag or reason as for maybe to back off some of the offensiveness that we would typically see this time of year. Hey, thanks again, and again, happy Thanksgiving. Don't forget you got the opportunity to schedule a meeting. Either call 800-928-4001 or scan the QR code. And lastly, don't forget your opportunity to listen to Consider This, our weekly radio program, either on WIBC on the flagship weekly radio spot or through a podcast, however you get yours. So again, happy weekend. Hope you have a good time with your family and friends.